Ladies and gentlemen, boys and girls from all over around the world, my name is Brandon. I'm with the Rags to Riches community. I am the master and commander. I'm the CEO and the supreme Ayatollah, Carlos. How the
What's
hell
up?
are you today, man?
I'm good, man. I'm excited to be here.
Y'all excited? Yeah. I'm
Yeah.
excited for you to be here, man. Hold on. We're actually streaming live right now. We're actually streaming live with a Twitter space, and I had my microphone off. So now it is on and we're good to go. Carlos, I reached out on you. I reached out to you on Twitter and I wanted you to come on board here and be able to speak intelligently about tax law and tax structure at large. And apparently, you know something about that. So introduce yourself a little bit here and let everybody kind of know what you do.
Yeah, sure. My name is Carlos, and I run an accounting firm here in LA in the West Side. And the accounting firm has been going on for like 56 years. So now I'm in charge of it. I run it, so I'm in charge of all the tax, educating all the accountants here and making sure that we are following procedure and that we're keeping up to date with everything that we're doing because we're signing off on tax returns. So our firm specializes on tax strategy. So we're moving into more like crypto. So we open up a whole department just on helping people, get their cryptos, tax documents ready. So yeah, if I can help out with the community, I'll be happy to contribute. I'm a Hexacan and I'd be happy to. I started diving into the protocol to understand a little bit better, so we can make it an actual stance on how we're going to report it on the tax returns. So that's why we're here today to see if we can explain it and have it out in people's,
In their forefront,
whatever.
right?
Yeah, yeah, sure.
I think it's awesome. I think it's awesome that you're an tax attorney and you're diving into the structure of Hex.
Well, I'm
And
not. I'm not a tax attorney, just to be clear. But
oh, a tax.
yeah.
What are you exactly?
Well, my title is tax strategist, but
Strategist. Okay,
yeah,
that
whatever.
was my slip up. So the neat thing is you are a person who is familiar with Hex, and you're going to also be a person that's able to shed light on, the future implications of things like staking, and rewards, etc. Correct?
Yeah.
So now that let's just talk about that then, right? So let's talk about taxation on staking and rewards with Hex specifically. What are your thoughts on that?
Yeah. Uh, well, for us to understand how hex stakes work, I think it's great if we kind of work backwards as far as by process of elimination of what hex is not. So then we can be left with what it's the closest thing to the stance that we have currently, right? So as far as staking rewards, the word staking is just thrown out there like crazy. They just think that everything's staking, but we have to differentiate what true staking is. And what true staking is basically sending your coins to a validator for the proof of stake network to be secured and for those blocks to be processed. And if we consider that those staking rewards are actually considered income as if you were providing a service. So therefore, those staking rewards would be subject to self-employment tax with the current legislation that we have. Now that might actually change because of the Tezos case, and I hope it wins by in court by 2023 in March, and then those would be tax different. But currently, that type of activity is subject to self-employment tax, and the people that are providing those that type of money for the securing of the network, then they would be subject to self-employment tax. Now, is that what Hex does? No. Now, right? We don't have a proof of stake network where we send our Hex or anything like that, and therefore our Hex stake rewards are not subject to income tax nor self-employment tax because we have now eliminated that sort of activity. The next type of staking reward that then we have is on the passive side. So are we then receiving interest? So the definition of interest, like hex staking rewards does not fall under the definition of interest because we're not lending money.
Okay.
So therefore we have to stop using the word interest. So I think that when there was the conference, people started saying the percentage of inflation that we're receiving, right, or the yield,
Right.
which is better, I guess. um, but then we're not going to tax this as interest.
So
uh,
lending is associated with interest, and
that's
there
right.
is no lending. We're just interacting with the contract.
Yeah.
Okay, that makes sense.
Yeah. So then we go into the fact that it's not either income nor interest. So then the next type of staking reward that we would be, as far as a category for us to kind of put it in there would be capital gains.
Okay.
So then we got to look at different protocols that are already doing this. So for example, I looked at Compound and I looked at Yearn Finance. So when I started looking into Compound, what you get is, as far as the understanding of how Compound works, is that you go ahead and let's say that you have 1,000 DAI, and then you provide that DAI into the protocol. What you get in exchange is something called seed DAI.
Okay.
And that seed DAI is not like it's increasing in quantity, right? The seed DAI is just increasing in USD value. So over time, as you earn yield on that seed DAI, if you decided to cash out from that seed DAI or exit the protocol, you would then, let's just say that you had $500 in gain as far as the percentage of yield. Then that $500 you would then get 1,500 DAI. Now, how is that taxed? Well, that $500 would be capital gain,
Okay.
right? And just to be clear on that, I have something here. So, for example, the reason that he does that uh, is what we have to understand is that the quantity didn't increase, right? It was just the worth that you were able to pull out uh, what increased
The
basically.
appreciation.
Yes. So therefore, those tokens are going to be considered capital gains. So when we think about it in a way of a T-share,
Mm-hmm.
we can go ahead and assign a value as if it was like the CDI that we were talking about with Yearn, and a T-share has a certain value in USD. So when we think about, for example, a T-share being open, when we burn our hex and then we get a T-share in return, and we allocate that T-share to be alive, for example, for 1 month, it has a different value than that same T-shirt if it was alive for 5,555 days, right?
Sure.
So the tokens that are minted into existence, or as we basically interacted with the smart contract, the tokens that are coming out from that as rewards are taxed as capital gains. So in this case, Hex is more than likely to fall under the category of capital gains as far as the rewards. So, we have different topics that we can talk about as far as, what has been done before, as far as them considering the rewards as income and so forth. But we're taking the stance, in the firm here, that staking rewards, when received, are going to be at a cost basis of 0, and uh, and basically we're just going to go ahead and pay taxes on the fair market value on that, and hopefully the stakes that you have are long term, because now we get to enjoy the 15 to 20% special long term capital gains tax rate. And if they're short term stakes, then the short term capital tax rate is going to be just regular ordinary income.
Okay, so let me ask you this, and I'm going to ask you a lot of questions for the people in chat here that may not understand some of these terms. When you say the word cost basis of 0, what do you mean by that?
The Well, we didn't pay anything for that, right?
Okay.
So in a basic type of way to understand cost basis is your purchasing price. So if we purchase Hex for $1,000, our cost basis is $1,000.
Okay. Cool. All right. So let me ask you this too. You had made the comment that with the previous protocol that you were talking about, you said with the previous protocol, the actual amount of these tokens didn't change, but the price appreciation did, correct?
Right.
Well, with Hex, you're
But
getting.
let me just
Go ahead.
clear.
Yep.
It's not just the price appreciation, but we have to think about it as the quantity of like in hex coins, because the
Right.
USD value at the moment of the t-shirt doesn't really matter, but the t-shirt just accumulates more hex coin, over the capital amount.
Yeah, that was my question. Hex, you're going to actually get a larger quantity when you mint that
Yeah.
yield, essentially,
Yeah,
correct?
whatever the USD price is, it doesn't matter. Is the fact that the t-shirt in itself is providing extra hex coins.
Okay, cool. All right, so we're gonna kind of go through in between these topics and just take one or two questions, and then we'll hop back on topic. Does that sound good?
Sounds good.
Okay, cool. Um, yeah. One question that we have here, we kind of talked about the hex stakes, but more importantly, the pulse and pulsex sacrifices. What are your thoughts on the sacrifices?
Um, my idea of the sacrifice is still not super developed. I've been spending more of my time doing, as far as my position on the hex protocol so far. But if I had to say something about it, it would be that, some people have, as far as what they have told me and what I have thought about, is to send it into, like, for example, a lot of hexagons use Coinly. So they send it into pools so they can consider that sacrifice as, like, let's just say, the new cost basis for the coins that they receive for Pulse and PulseX. Some others went through the Sense Foundation and therefore is a legitimate donation. And then some others, they're considering it a deemed sale. And there's, like, I can go on and on and on as
What's a
far as the
deemed
type of.
sale?
A deemed sale is as if you were to have a capital loss, meaning that the
Okay.
tokens were just deemed to be sold at a value of zero, for example, and you were going to then write off the whole amount of the capital loss. But it doesn't, in my opinion, as far as what I have researched in deemed sales, it does not qualify because it's only for passive foreign investment companies that you would be allowed to do a deemed sale on the shares. And I know that Toby brought this topic in the conference, and I reached out to him to see if he can talk to his attorney to see if we can have some sort of clarity as far as what he meant with deemed sale, and if it's something different other than, the passive foreign investment companies that I'm familiar with. So if his attorney can provide with a public opinion about the deemed sale, I would be happy to humble down and learn what it is, if there's maybe more advanced topics about it. But as of right now, my opinion is that you shouldn't write it off as a capital loss.
Okay, cool. And then the next thing I want to do, if you guys just joined on YouTube, I actually have a simultaneous Twitter space going on right now. So, what I want my mods to do, if you have a question in the Twitter space, go ahead and raise your hand. I'll give you guys about 10 or 15 seconds, and I'd like to field that. Yeah, go ahead, crypto Bitlaw.
Hey, yeah, thanks for taking my question. I think my main question has to deal with how we're treating, Hex when we're actually out converting the T-shares back into Hex, and how that's going to be treated. Why he's choosing to approach it as capital gains. Based on my understanding, when you get more of a quantity of a thing, that's treated as interest versus more of a value per principal is actual capital gains. So if you could expound upon that, and then I have one follow-up, if you don't mind.
Sure, thank you. Go ahead. Did you hear all that?
Gains.
Yeah, I did. So, Crypto Bitlaw, nice chatting with you again. The reason that I'm picking it as that is because, the simple understanding that we have on staking rewards right now is as that we're going to consider any extra tokens as just regular income or interest, right? But we have to break that down because the definition of interest does not fall under the category of hex. We're not lending our money, so therefore interest is not really the the way to go. Like it would just be in violation of what would actually be reported, right? Like we're literally not lending money out, so therefore it's not interest. In addition to that, as far as the other type of protocol, as far as what has been indicated as far as the staking rewards, we're not either securing the network through a validator for a proof of stake network, so therefore it's really not a service, or we're not getting portion of the transactions as a liquidity providing or anything like that. So therefore we would not be able to consider it as income either, because we're not doing any of that within the Hex protocol. But some DeFi platforms like Yearn and Compound distribute interest not as additional tokens, but increase the value of a lender's interest bearing tokens, which is kind of the same thing as a t-shirt. Now, the proceeds are taxed as capital gains and not ordinary income with these protocols. And this is because the number of the tokens in the lender's wallet does not increase, but rather the existing tokens increase in value. So, in the t-shirt, you're not getting more t-shirts, as interest or as staking rewards, but it's basically the t-shirt in itself, it's increasing in value. And I can give you the example of, like, for example, the new project Hedron that I haven't fully gone through it, or I haven't really tried to understand it, but the general concept that I have with it is that you could wrap your stake, created some sort of NFT or whatever, and then you can access some sort of liquidity with that, and if you have a stake, that is 5,555 days, I imagine that that's a lot more valuable than one t-shirt, for 1 month, because that one t-shirt is only going to produce a certain amount of Hex coins. But the one t-shirt that is staked for 5,555 days is going to produce a lot more Hex coins. So the value of the t-shirt in itself is not increasing. The like, we're not getting basically an increase on the coins, right? It's basically the value of that wrapped token, if you want to have it that in, like, as a comparison, or the basically the token that they got in exchange, because we're getting something in exchange, like in company CDI, we would get basically the t-shirt that is increasing value. And when when we exit the t-shirt, or when we basically end the stake with the t-shirt, we end our interaction with the smart contract, we then get in return more Hex tokens because of the value of the t-shirt in itself. And that in itself would be considered a capital gain as far as how we consider those staking rewards.
Cool. All right. And Crypto Bit Law, you said you had a follow-up, or do you have any questions about what he said?
Well, yeah, I appreciate that answer. I want to understand why we're recognizing the end stake as a taxable event.
Yeah.
We put Hex in when we buy the t-shirt, and then we get Hex back out. Can we continue to keep restaking and end staking and only recognize a taxable event when we go from Hex back to fiat?
Well, that's a very common misconception that we have when it comes to what is a taxable event. The misconception is that if we don't go back to fiat, it's never a taxable event. So if I go from BTC to Ethereum, then that wouldn't be a taxable event. And as a matter of fact, that has been stipulated clearly, that any crypto to crypto transaction would be considered a taxable event. And in addition to that, any receipt of new tokens would be a taxable event. Now, the definition of taxable event obviously varies into, well, what kind of taxable event would it be considered? But at this moment in time, we can just say that any additional tokens that you're receiving would be some sort of taxable event. And maybe there's some sort of protocol that it wouldn't be a taxable event, right? Like, for example, liquidity providing, when you are getting a liquidity token in exchange of that, does the wrapping of the token or getting a liquidity token is a taxable event because we're going from one crypto token to another crypto token? There's absolutely no indication that there's any instruction on that. So as far as a true answer, I can't give you because there's really no instruction on it. But we have to consider the fact that the staking rewards that we're receiving, or the additional Hex that we minted into existence in addition to the capital, would constitute a taxable event. And we were in the past considering it as if it was just regular income. Now we're changing our stance that our protocol does not constitute, Hex protocol does not constitute any sort of income or as ordinary income or self-employment tax or subject to self-employment tax or interest. The only thing left that is comparable to any other protocol that has some sort of similarity to it would be capital gains.
So, okay, cool. And I think, go ahead.
Hex to T-share be a taxable event, in your opinion?
What a hex to a T-share? Is that what you said?
Yes, sir.
Yeah, hex to a T-share.
And no, the simple answer to that is no. Is it could be, right? Because if we think about it, crypto to crypto, but a T-share is not a crypto token. It's just a like a wrapped version, right? But if we really want to get into the technicality of it, it's not really an exchange, because we're burning our hex, and we just happen to have a T-share, so we didn't really buy the T-share. We burned our hex, and then we burned the T-share. So it's not truly like a swap.
So you're kind of saying, like, if I understand it correctly, at the beginning, we take our hex, we take the price appreciated, the value of the hex at that time, and we create our T-share.
Mm-hmm.
But then the reason at the end that it can be a taxable event is because the price has appreciated, and
price has nothing to do with it.
Okay, but then you minted your yield. Is that why? Is that why you're saying that it's taxable?
The additional, think about it this way, the airdrop of Pulse Chain, all these different coins, let's just say that let's say that they came in at a dollar value. We know that they're not, but let's just say that they did come, a regular airdrop that you would get, right?
Mm-hmm.
So the regulation as far as how an airdrop is supposed to be taxed is that the fair market value when received, and that you can took control of that airdrop. So if we see that the intention of the IRS is to tax us on any additional tokens that we're receiving, whether it's providing a service or an airdrop or something like that, we can just say that they have the intention to tax us in some sort of way, on additional tokens received. So when we're burning our hex, for the T-share, and then we end our stake, we're going to get our capital back in addition to all the yield that we received, right? And that is conformed by penalties of the protocol, of other emergency end stakes, in addition to the percentage of inflation that we receive. So those combined additional hex coins that we received, which is combined of the penalties and the percentage of inflation, should then, if we see the intention of the IRS, tax in some sort of way. And the best tax treatment that we can find is long-term capital gains. So having this said, we don't want to have many short-term stakes. We want to have long-term stakes. So when we do receive those additional hex token rewards or hex token coins, then we can go ahead and consider them long-term capital gains.
Cool. And just to let people know here, if you need to pick up and go and you can't watch YouTube, we are streaming this live in Twitter Spaces. It's called Heart After Dark #2. And you can see that I am a part of that. Crypto Bit Law, did that answer your question sufficiently, or did you have a follow-up?
Yeah, it's starting to answer my question. The problem that I'm having is I'm trying to figure out why you're recognizing a cost basis of 0, and then you're recognizing a taxable event at the end stake, when you're putting in hex at the beginning at a certain price you got the hex at, and then you're getting out later. If you get out later for the same fiat amount, why should you pay tax when you don't have an actual gain in terms of the value of your hex?
Yeah. So we're not going to consider, forget about the USD value, right? Like just for a second. And let's say that let's talk in terms of hex coins. You put in 100 hex coins and you burn them in exchange of a T-shirt. Let's just say that a T-shirt was magically 100 hex. That would be beautiful. But in this case, let's just say that we have 100 hex. We then get a T-shirt in exchange. And then when we end our stake, we get 150 hex coins. Basically the basis, as far as what you purchase, that's, the 100 hex coins and the 100 hex coins that you got at the end, 150, you're going to split it between those two. You're going to split the 100 that you received for your capital, And obviously, you're not going to get taxed on that. So the USD value, let's say when you bought those 100 hex coins at the beginning was $10, and then when you ended your stake, it was worth, $100. It's not like you're going to pay taxes on your initial capital, considering the quantity of the coins. The 50 additional hex coins that you got, that is combined penalties and percentage of inflation, is then going to be considered then the zero capital gain, like the zero cost basis, because those additional coins that you got, you didn't pay for them. You didn't. So therefore, the cost basis on that is zero. And if and the fair market value when received was, let's just say, whatever X, it doesn't really matter. So therefore, you will then have to recognize the capital gain on those additional tokens that you got for free, basically. And the 100 coins and the 100 coins that you received, like, that's really not a taxable event. So you have to separate between them too. And Coinly has done an amazing job. By the way, they're hexagons too. And but they have the concept that it should be taxed as income. So I need to have a conversation with them, with maybe Constantine or something like that, that will allow us for us to have it as a capital gain transaction. But does that answer your question specifically? Is not the basis, is not the original hex coins that you got in there that are subject to capital gain, because you haven't sold them. You just kind of got them back. Is the additional hex coins that are subject to capital gain tax.
Yeah. I mean, it's still. I feel like this issue is probably going to play out at some point. Maybe in the courts through litigation.
Absolutely.
Not there's an actual, transfer or swap whenever you're going from, actual hex to T shares. That's still kind of one of the, confusing points in my mind, but all in all, I like where you're going with this. I think it's a good take on it.
Thank you for asking that question. Carlos, thank you for answering very well here. And what we're going to do is we're going to move on to the next topic. And our next topic here is going to be we're talking about proof of stake networks. You kind of touched on it before, but in terms of taxation, what are the implications of taxation with regards to proof of stake networks?
Yeah. So in this case, we can talk about Pulse.
Pulse
chain. Yeah.
Yep.
So, Pulse chain is a proof of stake network that is going to have 32 validators, if I'm not mistaken.
Yep. 32. Yeah.
And they are going to basically perform a job. And whoever delegates money to them, let's just say that one validator, right? Validator, doesn't require anyone else's money. He puts up all his capital for his node.
Okay.
So therefore, he's substantially participating on the staking to secure the proof of stake network. This individual that doesn't require the capital of anyone else because he's putting up his own capital would then be subject to self-employment taxes. So for that sort of activity, it would be advisable to maybe form an S corp around it if he's in the US. Obviously, it depends on the jurisdiction where the validator is taking place.
So just to let folks know, and I hate to cut you off here, but I want to make this very simple for people. When we're talking about validators are essentially the folks that keep the network running, keep Pulse network running, right? Pulse chain.
Mm-hmm.
So these validators, because they put up all the money for their servers, for everything on their end to be sure they're up and running 99.99% of the time, and they didn't take money from others. Essentially, you're saying that it would qualify under like self-employment tax, correct?
Yeah, if they were a U.S. citizen with no sort of corporation around it, then yeah, they would be subject to self-employment tax because the participation on the node operation is substantial and therefore would be a business.
Okay, and this is juxtaposed to the next part of this, which is people who delegate or they send their stakes essentially to the validators. So how is that different?
Well, it's different because then we go into what is a partnership between, or that you basically are not participating substantially on the operation of this business, right? So it's more of a passive activity. Let's just say that you and the delegator are 50-50, right? You provide 50% of the capital, or that you provide 100% of the capital and he provides the operation of the node, then that you too would be subject to self-employment tax or as a business type of revenue. If then 100 different people delegate their PLS into a validator, the substantial participation of this activity is basically not non-substantial. It has been divided up to a lot in between a lot of different people, and therefore it would be a passive activity, and that would just be taxed as regular income. So in that, going back into crypto bid laws point, those type of staking rewards are coming from the securing of the network of a proof of stake network, and therefore it would be just taxed as regular income, not interest, because we're still not lending our money to like a lending platform like Aave. It's basically to secure the network. So now it would be just taxed as regular ordinary income.
It's taxed as regular and ordinary income because they are participating in basically the stability and the security and up the infrastructure of the network by staking with that validator.
Yeah, and it's not substantial activity. Substantial activity is a key term as far as like that you don't have a significant amount of the share of the pool, right? If it's more than 20%, then you are substantially participating on the activity, and therefore you would be subject to self-employment tax.
Why is 20% a rule that they have? Where did that come from?
Yeah, it's like the substantial activity. It's like, are you
20%
substantially are you substantially participating in an activity? So therefore, like if you were a substantial shareholder, you probably have more than 20% of the shares. So then you would have substantial participation on it, unless you are fully just passive, right? But in the terms that we're speaking of right now, as far as the staking rewards and securing the network in a proof of stake network, it in a pool that a lot of people just participate, hundreds or even thousands of people participate by delegating their PLS, it would be passive.
Okay.
The operator might not, though. He might have a greater percentage of money that he participated, so he might have like 30% of the funds, so he still then be subject to self-employment tax.
Okay, cool. And Joe Dirtwin, thank you so much. $4.99. And this was kind of answered in the previous question. If we restake the full amount of hex after in stake, how does that play out in capital gains terms? Since they're never sold at market, we pretty much we talked about that. Quick overview. In your opinion, what happens when we mint our yield at the end of our stake?
Yeah, we're still subject to capital gains tax in the position that we're taking, and even if we don't sell it into fiat, we would still be subject to self-employment tax, right? Just for us to cover the fact that we received the reward. If then we choose to restake that amount, we have a new cost basis, basically because we're already paid the fair market value of that hex coin that we received. So we have a new cost basis that is not zero because we already paid for it.
Cool.
So that's my answer to that.
Cool. And Davis, this is along the same lines, but a little bit different scenario. You staked 1 million hex and minted 2 million at a cost basis of 0. Would you take a loss of 1 million hex for the tax year you created the stake, or do you have to pay capital gains on the 2 million hex?
Let me read that again.
Yeah, read it again.
Yeah, you staked 1 million hex, okay, and then minted 2 million. Well, just by that, like I don't need to read anything else. It's like whatever the USD value it is, the million hex, when you unstake the 2 million hex, the million hex that you originally put in is not subject to capital gains.
So it's 1 million then, correct?
So only 1 million out of those 2 million would be subject to capital gains tax.
Okay, yeah.
And hopefully, like I said, we want to encourage, like the good thing about taking this legal position as far as the stance, with how we're going to do the tax return is that it incentivizes people to actually do stakes longer than a year.
Absolutely. And the advantage of stakes longer than the year are in the US or the differences between the two capital gains tax rates, short term and long term, correct?
Yeah, absolutely.
Short
because
term
one is taxed as ordinary income tax. So whatever your tax bracket is, 20%, 40%. And capital tax rate is 15%. It's actually 0%, 15%, or 20%. And you could actually qualify for a 0% if your income is under like $40,000. I forget the limitation, but you could have a substantial amount of capital gains, long-term capital gains, and pay zero taxes on it.
So there actually is a massive advantage for crypto millionaires to work at McDonald's.
Well, not really. I mean, if you have like crypto, if you have $1 million capital gain, that would be subject to like your capital gains.
Unrealized crypto gains. Yeah, you might want to like get a $15, $20 an hour job maybe.
No, I wouldn't suggest that. But
I put you on the spot. All right, so let's get into the next topic here. Let's see here. Yeah, let's talk about lending in the crypto space, because I know that there's quite a few folks who are part of different protocols that deal with that. So what are your thoughts on that?
well, lending is we have to distinguish what kind of lending we're doing, and we have to make sure that the protocol that we're participating is actual lending, and whether we're doing peer-to-peer, which is active participation, or we are actually giving our coins to a custodial or a broker that would then in exchange lend it out to different people. So the first step is to differentiate whether we're doing active participation or passive participation through a custodial. And then the second thing is that if the protocol that we're participating in, it's actually lending, right? Because like I said, we confuse a lot of these stuff everywhere. And you have to see whether BlockFi is actually a lending platform, or whether whatever, I mean, the Aave or any other type of platform is actually lending. So we would then consider those as interest received if it does fall under the category of lending.
Okay, outstanding. All right, I wanted to take another question from chat here. If there's anybody in chat that has a question, raise your hand and I'll call on you. And if there's anybody that isn't a speaker that has a question, just you can request a speaker position here and we'll bring you in. Okay. Doesn't look like we have any questions there. All right. So guys, if you're wondering what I'm doing here, we have a Twitter Spaces. It's called Heart After Dark. It's Heart After Dark #2. You can check that out by going to Rags to Riches Fam. You'll see that we're in there. So let's take another question here. This is an interesting one. If I were to advertise for Hex, for example, with a vehicle wrap or a billboard or radio ad, is it a write-off at all?
No. The simple answer to that is not, but however, it could be. And
Okay.
Let's say that you had a marketing corporation, that decided to do some sort of like marketing strategy or something like that. Obviously any operational cost that you have would be deductible. But if you're an individual only, with a regular job, a W-2 job, and then you participate in crypto and you have staking rewards or whatever, there's absolutely no way that you're going to be able to write that off. So it has to be under some sort of business intent with a specific or the proper formation or structure, that in which case you would be able to write off the vehicle.
Okay, outstanding. One question here from the same guy. Has the federal tax code officially been written pertaining to cryptocurrency at all?
Has a federal tax code officially been written pertaining? Yeah, well, some of it, like capital gains, has, as far as, the fact that cryptocurrency is considered like property. So therefore we have, sufficient evidence and, well, indication that if we buy and sell cryptocurrency, it should be considered a capital loss or capital gain, so that's definitely given to us. The fact that they're asking for any sort of activity for you, like they specifically ask on the tax return, did you buy and sell any or exchange or send any sort of cryptocurrency? And they basically do want to know about that. And also they have published specific indications on how hard forks and airdrops are supposed to be taxed. And yeah, is not official like legislation, like every single protocol should have their own instructions sort of thing, but we're kind of basing it a lot of the activities that we have just based on that information. So a lot of it is not written specifically. So we're just kind of trying to make our best guess with the current legislation that we do have. Like, are you providing a service or are you passive? So that's how we're basing the decision on how your staking rewards, for example, should be taxed. But if, for example, the case of the Tesos, the Tesos staking passes through, the whole conversation that we just had about the validators receiving staking rewards for the proof of network, like to secure the proof of network, the proof of stake network, that would go out the window, because then the staking rewards would not be taxable at all. And then
So
we could
talk to, so
probably
we've touched on Tezos. We need some context there. So talk to me about that.
Okay, Tesos is a protocol that that it's a proof of stake network, and the validators basically have the staking rewards, like Pulse Chain, for example. They whatever they It's basically just that. So there was a couple that submitted their tax return and they paid their taxes on the staking rewards that they received. Then they sued the IRS, and they basically requested like $3,000 back as a refund, but they came in with a big team trying to have the IRS refund that with a statement to actually put some legislation into writing as far as how that is supposed to be taxed, to give us some sort of instruction on that. Now they tried to settle the case, the IRS, like without providing any sort of statement. They were just like, hush, hush, here's your $3,000 back. We'll give it to you, but we're not going to provide any sort of statement as far or instruction on staking rewards. So the couple basically rejected the settlement. They're like, nah, we're going the whole way and we're going to take it all the way to trial. And trial is supposed to be on March 2023. Crypto Bidlaw is actually staying up to date on that very, very well. Like, he's an attorney too, so he explains the everything very, very well. But that's what happens, right? Like, if they do win the case, which, when Crypto Bidlaw said, he was giving his opinion about it, he's like, I think that they have a pretty good case about it, and hopefully they're gonna be able to win, and they have a big team, backing them up. So the proof of stake network would then be, the staking rewards would not be taxable if that goes through. So legislation is always changing.
Yeah, it's a very fluid and dynamic situation, probably here within the next 3 to 5 years, as cryptocurrency kind of becomes more in the spotlight of the public and the regulators and the people who are seeking clarification in terms of the law. So it's going to be good for a lot of us. It's going to be painful for some of us, but ultimately it needs to be clarified for sure. One question here. Can he comment on unrealized gains? What advantage do people have if they take advantage of the Foreign Income Inclusion Act as an American with regards to HEX on staking? Are you familiar with that?
The foreign income inclusion or exclusion, I'm not sure what he refers to. If he can kind of expand on the either exclusion or inclusion. But
Yeah.
as far as a comment on realized gains, I'm not sure if he's referring to the new infrastructure bill that kind of proposed that unrealized gains would be taxable as well, which is completely stupid, because imagine you buy a house and then suddenly you have equity and then you have to pay tax on that. That would be very, very stupid. Imagine Wall Street, with all the stock positions that they have, that they hold for long term, that they would have to pay tax on that. That would be very, very stupid. Obviously, you know they're the ones that are they're the ones that have the most assets. They're not going to let that kind of go through. So as far as taxation on unrealized gains, is just something that people are kind of talking about, that those are going to be taxed. But it's just so impossible for me. It's I think it's impossible for it to pass through. It would be so unrealistic and stupid if it actually does, and it would complicate things quite a bit. And as far as the foreign exclusion, if you know I'm not sure what he means by that, but there is a foreign exclusion of income, that if you are an expat, like
Mhm.
meaning a U.S. resident or a U.S. citizen that lives in a different country, then you can exclude all your income from reporting it in the United States. So then you only pay taxes in that foreign country, and you have to fall under certain guidelines that you can't be in the United States, in the country of the United States, for more than a certain amount of time. And yeah, I guess that would fall under the exclusion amount. The only thing that doesn't fall under the exclusion, I believe, is like self-employment. I have to kind of freshen up on that. But yeah, any
He
sort of
did clarify. He meant foreign earned income exclusion.
exclusion. Yeah.
Yeah.
So that means that he lives in a different country. Let's just say that he's living in Malta or that he's living in Portugal full time. Then all the income that he receives, because the reason for that, just to give you a little context, is because the United States requires all U.S. citizens and residents to report global income, no matter where it's coming from. You have to report it. And let's just say that you're reporting income from dividends in England. Well, the England government actually withholds taxes on those dividends, right? So if you were to report that global income here in the United States, that would mean that you have to pay a double tax, So the exclusion is for basically not paying that tax in the United States and excluding all of your income to be reported in the United States. And therefore, you would only pay that foreign tax, in whatever country. And if you happen to be in a country that has zero tax, you basically exclude all of that.
Awesome. Thank you for answering that. The next topic that we kind of want to just brush over here is smart contracts that produce tokens. What are your thoughts on that generally?
Yeah, well, that refers to the compound, basically, like they're interacting with a smart contract that basically increases in value, or like in the actual currency, right, that they would be paying out. And that would be basically my opinion on the smart contract as far as the T-share. So there could be other opinions that I would welcome. I would love for me to have a discussion back and forth, as far as breaking this down. But yeah, the T-share is a smart contract that increases in hex coins value, right? And therefore it would be subject to capital gains. So I think we already kind of talked about it.
Okay, cool. And chat here in our Twitter spaces. I'm going to open it up to you guys. If you guys have any questions in here, please let us know. If you want to ask a question, you can request a speakership, and our mods will let you come through and ask a question. I'll give you about 5 or 10 seconds here to do that before we move on. All right.
I got 2 questions, if I could.
Yeah, absolutely. Go ahead. Speak clearly.
Yes, thank you. The first question, I missed a bit of the beginning part when you were speaking about sacrifices. Could you please just maybe reiterate that again? I know that you mentioned that a deemed sale of zero value was not an approach you were taking. So could you maybe please summarize the approach you would take?
Yeah, sure. That would be kind of putting me on the spot. But so I have to disclose something. Anything that I say right now, please just verify it, because I would like to actually talk it over with some people. But as far as my personal opinion about it, is just basically you sending tokens out that, to make a political statement. So it really means nothing, so it would just be that you kind of lost your position. It's not a capital loss, right? Because you didn't sell the tokens. Now, we have to understand a little bit about what happens when we send crypto to someone else. When they're providing a service or we're buying a good, that becomes a taxable event when we send crypto to someone else. So then we have to ask the question, well, if we send anything other than a stable coin, is that a taxable event for us? Now, the sacrifice phase or the sacrifice was not a good or service, so we can go ahead and take that off the table.
A good what?
A good or a service.
Oh, good or a service. Okay.
Yeah, so we can take off that table as far as it being a taxable event. When we send crypto to buy a good or a service, that's when it actually becomes a taxable event for us, because that position has to be liquidated, right? So if the sacrifice phase was not a service or a good that we bought, then we take that off the table. Okay. Now the next thing that could happen was that, is it a gift or is it a donation? So a donation, it's only to when we send directly to a 501c3 entity. Is the OA a 501c3 entity? Hell no. So and whoever did a sacrifice for the Sense Foundation definitely did it for a 501c3, and therefore they were going to go ahead and get the tax benefit of that donation as far as what they can write off if they're itemizing deductions. Um, and is it a gift? That's more likely what's going to be considered, right? It might be just like a gift, because if we consider that we're actually buying a token, that's expectations of profit, and it was clearly the information was given and announced in the websites and through Richard Hart that they would have zero expectations of profit from the work of others, because then it would violate uh, the Howey test. So I would say that it's not it's if it's a political statement, donations to a political statement are still non-deductible, but it's still not a 501c3 or any sort of nonprofit organization. So I would say it's just basically a gift. Um, if the gift is greater than a certain amount, it has to be reported um, under a gift tax return. Under, I think it's like 15,000.
15,000. Yeah.
Yeah. Then it would have to be then reported under a gift tax return, and then that would reduce the amount of your state allowance, which I think is $11.5 million or $10.5 million. I have to look up the number. And that would just be a reduction. It's not a taxable event. It just reduces the amount of state allowance that you would have in case you pass away, as far as what you would be inheriting to your beneficiaries. So for me, I'm just considering, as far as if you're seeking guidance, like in Coinly, for example, what I personally did on both sacrifice. Well, I haven't done the PLSX one, but I categorize the PLS sacrifice on Coinly as sent to pool, and I will never ever get them back. There's some people that are trying to consider that as the new basis for the PLS that they're going to receive, but I'm not going to do that. So I'm just going to go ahead and send it to pool, never see it again, and that's it. I'm not going to write it off either.
Outstanding. Now, this is what I want to do here is let folks know that I am super, super stoked that, Carlos, that you came on, man, and you're giving out some incredible information. And I wanted to point this out in the green room. Carlos isn't here to shill his business. He's literally here to help this community out because he's a Hexagon, and he wants to give value to folks. In fact, he has probably too much business, way too much business right now to be able to take on much more clients. So I just wanted to thank you, Carlos, from the bottom of my heart for coming on here. And I want to let folks know this too. All Carlos, we kind of talked about it and we kind of agreed that we need to get Carlos some followers. Okay. So if you did nothing else, if you didn't do anything but just listen to this, if you took away some really valuable nuggets that you in fact can take back to your tax advisor and ask some good questions about, give Carlos a follow. And you can go to my Twitter. I just tagged Carlos. You can go there, follow him there. His name is Carlos D. Quintana on Twitter. And I'm going to go ahead and I'm going to copy this and paste this in the chat here for everybody to see. And so it's super worth it, guys, to give this guy a guy a follow. And also, it's 7 or 8 o'clock your time, 12, 11, 10, 9 o'clock, 9 o'clock your time. Staying after work, those long hours, man. And I'm just here yapping away, and you're like, shut up so I can go home and watch, Hawaii 5-0 or whatever people watch in California. I don't know. All right, chat, I just sent that. We're good to go. I'm going to ask everybody right now, if you have any other questions, we're going to go ahead and let this gentleman go. We're going to thank him up and down. Please go to my page, my Twitter. You can see where I've tagged his Twitter. You can also go directly to Carlos D. Quintana on Twitter as well and give him some follows. Here in the chat, in Twitter Spaces, if there's anybody that has any further questions for him, please, please, please let us know. And I'll give you guys 10 seconds here. Go ahead.
Sorry, just one last question. It has to do with airdrops. So understanding that when you get an airdrop, it's a taxable event. At the moment, you get the airdrop at the fair market value. However, these days, there's a lot of dusting attacks where these scammers
drop tokens into your wallet without even your knowledge, and they put some value on them. And pretty much when you interact with them, you have to give them approval, and then they rape all your funds. So as a security measure, we don't interact with any tokens that are airdropped to us that we don't know about. How does the tax attorneys deal with that, in that we may have a value in our wallet that we don't touch?
Yeah, that's a great question. And that would be that the condition for the airdrop to be taxable is that you take control over it. So if you, because I have experienced that too, like I suddenly saw my Coinly and I have like all these different airdrops, and I was like, I don't want this, because I looked them up. I was like, should I claim them? And I was like, oh, scam, whatever. And yeah, if you don't take control of it, because you have to interact with their protocol, right, to sign the MetaMask fee and all that. So if you never take control of those tokens, they're not taxable at all. If you then take control of, like, for example, all the PRC20 tokens that you will be receiving, then once you take control of those PRC20 tokens and they're tradable, then that would be the moment in which case you report the fair market value. Because if a token is not tradable at all, then you haven't really took full control of that token, because you can't liquidate or anything like that. So the good thing about, for example, the PLSX launch and the PLS launch is that, well, the Pulsar line, the PulseX, is that they're going to be tradable between each other before the bridge even happens. So at that moment, we have checked that little mark that they're tradable, and you have now, taking control over them. And the good thing is that Richard R is like a genius, and he is going to assign a zero value on that, because then our airdrop that we then control and have now control over it to be tradable, then it's zero tax, on that airdrop that we got. So, thanks to Richard Hart for his massive genius for doing that. But yeah, I hope that answered your question. As far as other types of airdrops are only taxed when you fully take control of those tokens.
Outstanding. If there's any more questions here in the Twitter space, let me know. Carlos, this Twitter space thing went pretty smoothly, man. I'm pretty surprised.
Yeah. Everybody stayed quiet.
Yeah, kept you busy a little bit, man.
Yeah, that's good. That's good. I'm hoping for maybe other like tax people to come on and like give me some pushback so I could, we can research and grow together. That's basically the point of being a Hexagon. You grow the community and you help each other out, with whatever we can.
You think I can get my CPA license in like 2 months and we'll get back on here and chop it up? What do you think?
Yeah, man, it's super easy.
All right, man. Well, dude, I super appreciate it. I'm gonna be bringing him on as his schedule allows, because he's a very busy man. If there are changes in legislation and things like that, I'll invite him on, and hopefully he can kind of shed some light on what's going on here. So, dude, I really, really appreciate it. And then I always do this with pretty much every professional. I want to ask you directly, how much money did you give me to be on my show right now?
Nothing. I didn't give you anything.
Zero. Very, very important for me to point that out, guys. Thank you guys so much. And I'm going to be in my Twitter space. So for those of you on YouTube who are tuned in right now, I'm going to hop back into my Twitter space here. And I'm going to count us down here, Carlos. And you can hang out in the green room, and then we will go from there.
Thank you for having me. I appreciate it.
Absolutely, brother. Be good, man.